Good morning and welcome to this Monday, January 4th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. First off, Happy New Year, everybody. Those of you who said, can't wait for 2020 to end, well, it's ended. 2020 is now. I saw a couple of interesting memes, I guess, talking about the, when you talk about 2020 hindsight, it really is 2020. So anyway, I thought that was kind of funny. But yeah, it's good to finally be through with the year, although as bad as it was in many instances and on so many levels, I have to say, I'll always remember it for the year I became a grandfather. So I'm taking something very positive away from the year, and I'm looking forward to 2021. Hopefully we'll all get behind or get beyond and past the virus and get back to maybe a little bit more normal life as we move throughout 2021. But in the meantime, in the short term, everybody stay safe. Hoping and wishing everybody, good health in 2021, and let's get through all this together. All right, well, 2020 is in the books financially, talking about the stock market. We kind of all recharged our batteries here at Earnings Beats, took a little bit of time off. Some of us a little more than others, but that's okay. We wanted to get the ship righted and ready to go as we kick off 2021. I think we're in great shape here at Earnings Beats. I think the market's in great shape. Could we have pullbacks along the way? Of course, you have that in every market, but I do believe that the stock market is set up to go higher. I think there is tremendous pent up demand. Everybody I talk to can't wait to go on a trip or to go do something. And I think, as we start to see the virus cases fall, which I believe we're going to start to see as the vaccine gets rolled out, I think you're going to start seeing more and more folks willing to go out and do things. And that is going to be a major boon to not just the stock market in the U.S. I really think this is going to be a big year globally. And I'm not even sure what market leads. I think that'll have an impact on the dollar. I know the dollar is down this morning. We're seeing gold and silver and copper all getting off to a huge start here to open the year. I don't know if that's going to be the case throughout the year. I think the dollar will rebound, but that's something I'm watching. I want to kind of wait and see, because it's going to depend a lot on what areas of the world rebound the fastest. I mean, there are some areas in Europe that depend on tourism. So if tourism comes back, some of those areas could really explode to the upside. And I'm thinking about areas like, over in France and Italy and so forth, where they depend so much on tourism. Anyhow, let me go ahead and share my screen here. It is good to be back, though. It was so weird getting ready to do the show this morning. I was like, okay, what do I do first? It's been so long. I haven't done a webinar. I don't know. I feel like I'm not even working. Anyhow, first I'll take you over to Earnings Beats. Any of those, or those of you that are new to Earnings Beats, we do have a free newsletter. I'd love to have you. We've had a lot of really positive comments on our free newsletter as well as our service. So if you haven't tried our free service, there's no credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. We're just trying to provide some good analysis for our community, those who have supported us over the years. So make sure you sign up for that if you haven't already. Just requires your name and email address. That's it. And actually, there was a pretty good article today that I wrote looking at the heat map, looking at areas in the market that tend to be really strong in January. So I thought that, we do a lot of different things in that newsletter. Usually it's an individual stock that we like for, maybe it's an earnings report that's coming up. Maybe it was an earnings report that's the company's already had. We're looking at the gaps, something like that. Maybe it's relative strength. Maybe it's a certain area of the market. But usually it's some pretty good information. And sometimes it's a good, maybe some thought-provoking idea for a trade. Could be any of those things, but just sign up, name, email address, check it out. Also, great year for our portfolio. I looked when I was doing the portfolios, the weekly portfolio report that I do every weekend. And the model portfolio was up 100% last year, 100% in a pandemic. I mean, I know we were very fortunate in some ways. We were able, we were able very early to catch some of the technical indicators that gave us some clues, especially the accumulation distribution line was huge and very important in 2020. But still 100% versus the S&P 500, I think was 16% or something like that. I might be off. I'm going off of just what I was remembering from yesterday. But it was a huge year, and it was a huge year across all of our portfolios. But down here, you can see we update this. We didn't really update it much over the holidays. It was updated this morning, though, through last Thursday's close. So you can see since inception, just a little over 2 years, the model portfolio is up 201%. The aggressive since May 19th, 2019, so a little over a year and a half, up 69%. The income has definitely been our challenging portfolio. But when we look at all the numbers across the board, I think it's okay. We have one that's maybe not quite performing as well. And that really came down to one quarter, the income portfolio when the pandemic hit. A lot of the defensive groups got hit harder than usual, and that actually hurt our income portfolio. Strong AD just came out this past year, May 19th. I talked about the accumulation distribution line becoming such a big factor. It became such a big factor for us. We actually made a new portfolio based solely on the accumulation distribution line back on May 19th, 74.48% since May 19th through the end of the year. Pretty amazing performance for really just 7.5 months. Benchmark S&P did well also, 28.5%, but you can see that's probably about 160% above the S&P 500. Pretty strong results. Since inception in this quarter for the S&P, when we talk about this quarter, it's not calendar quarter. If you notice our inception dates, we always do our portfolios as of, this is for those of you that are new, February 19th, May 19th, August 19th, and November 19th. That's when we announce the 10 equal weighted stocks that are going to go in each one of these portfolios. So when we talk about this quarter, we're talking about that quarter that runs currently, the one that's running from November 19th to February 19th. So if you're looking at this and saying that's not what the S&P 500 did last quarter, it's not the calendar quarter. It's our quarter based on when we select our portfolios. Anyhow, great year. Let's get on and take a look at what happened last week. Last week or two, really we saw a little rotation. I was kind of frustrated personally because most of my stocks haven't done great the last couple of weeks. Maybe those of you that are Earnings Beats members know what I'm talking about. But it hasn't been bad for the NASDAQ. I mean, NASDAQ's gone up. I was watching growth versus value, which was kind of holding up okay. But it seemed like most of the stocks I had, the market didn't care for. And some of them have had big years. So I get it. There was some profit taking going into the end of the year. Probably some folks that had losses earlier in the year, from selling out during the initial COVID scare. You get to the end of the year and you've got all these losses. Well, you can start selling some of your profits and offset your losses. So I think we saw a lot of that. And the companies that did the best throughout 2020 seemed to be the ones that were selling off. A lot of the stay-at-home stocks, those kinds of stocks were taking it on the chin a bit last week. It'll be interesting to see what happens as we move toward earnings. I think we'll see a rebound. Anyhow, last Thursday, the Dow Jones Industrial Average finished up 197 points, 30,606. When we broke 30, I thought maybe we were going to make this run for 31, 32. It never really materialized, but you can see the sellers never really kicked in either. We did finish on the high, closed at an all-time high, the S&P 500 at 3756. Did the same thing, up 24 on Thursday, up 0.2%, both the Dow and the S&P. NASDAQ was up less, just a fraction, up 18 points, though, finished at 12,888. Certainly looks like we are poised to finish above 13,000. I wouldn't be surprised if we kick off the year with that. Mid caps, small caps, both up fractionally on Thursday, also performing very well heading into the end of the year. Look at all of our major indices, all of them above the 20-day, which is above the 50-day, and they're all rising. Hard to be overly bearish when we've got this configuration on the daily charts. To end the year, kind of a different group. Like I said, some of the strength that we saw: utilities up 1.5%, financials 1.25%, real estate 1.25%, and healthcare just a little over 1%. These four areas were four areas that really had lagged throughout much of 2020. So some of the money that we saw rotating last week was actually going into these groups. This will be another interesting thing to watch as we move throughout January. Do they continue to get that love? I don't think they will, maybe in the short term, but I fully expect that in a historically low interest rate environment that we're going to continue to see these growth stocks, the companies that can grow their earnings rapidly. I believe these are still companies that are going to remain in demand. Renewable energy, I just want to point out the one area of the market last week that really struggled was renewable energy, down 6 points on Thursday, more than 2%. But you can see we had a huge run in renewable energy in and throughout most of December. So the last week or so, we pulled back. Notice where we pulled back to, just a normal test of support. This was prior resistance. We broke out, came right back down, tested it, bounced off that 20-day moving average. And we're just in this range right now, trading range. So we're not in breakout mode anymore. We're consolidating. Nothing wrong with that. I expect renewable energy to remain strong heading into 2021 until the charts tell me otherwise. Moving on to the 10-year Treasury yield, I do want to mention we had we will have a couple of economic reports out later today. December PMI manufacturing expected to come in at 56.5. November was 56.7, so looking for a little drop there in December. November construction spending looking to pop about 1%. That's the estimate. October showed a rise of 1.3%, so maybe a little bit of a move lower in terms of construction spending in November. Construction spending is one of the economic reports, to be quite honest, I don't even think I need to talk about. I mean, we're talking about in our rear view mirror going back to the November construction spending. We're in January. The market's looking forward. Market could care less what happened back in November. But it is an economic report, so I'm just mentioning it. It'll be out later today. 10-year Treasury yield, let's get an update, see where we are currently. 9.45, 0.945, I should say. So 0.95%. I see an ascending triangle. I see a move up off of that August low. If you don't see the ascending triangle, I will show you what I'm seeing. So we got equal highs coming across here. I think you probably can see that. And then off of the lows here, I think there's your rising lows. So this is important. These types of patterns are important when they follow a trend. If you see a triangle like this and it's just in the middle of going nowhere, I don't pay much attention to it. But when we have a move up and then we consolidate, we keep it, think about just common sense. You're going up, you keep hitting this high, you keep trying to get through. And each time you drop a little higher than the time before. So you're not going down as much. So it's like, this pressure is building, and eventually what you expect off of an uptrend, you expect the breakout, continuation of the pattern. Now, if we break out, one of the things that's been helping financials, certainly since the vaccine began to roll out back in November, or at least the announcements of the vaccine, financials have done well. Well, if we get this breakout, expect financials to continue to do well. I would expect leadership from the group if we get the breakout. Now, I don't expect that the 10-year Treasury yield is just going to go flying to the upside. I really don't think that at all. But I wouldn't be surprised. I've said before, 120, 125, 1.20, 1.25%, maybe even up here to challenge this high, which is almost the 130. That, those are, or maybe it's a little bit over 130. Those are levels that I could absolutely see the 10-year Treasury yield moving to. But the Fed has told us rates are going nowhere for the next few years, at least the next couple of years. So, and I don't think rates are going to go soaring either. So I suspect we're going to remain in a low interest rate environment. I think that's going to be excellent for growth stocks. But when we do have these periods when the 10-year Treasury yield is rising, we should see outperformance from financials. All right. Next up, I don't know if you saw my article. I wanted to talk a little bit about this. This was the article I wrote in Chart Watchers over the weekend. And if you've been following my work, or those of you that are members of Earnings Beat, you know what I think. I think we're in a secular bull market. I think this market's going a lot higher. Folks think that, oh my gosh, we've made such a huge move. I think this is going to pale, not in terms of percentages. I mean, of course, we made a huge move off the bottom in terms of percentage, but you have to think about where we were at the beginning of the year too. Everything, you can paint any picture you want. Bottom line is, we've been in this secular bull market for a while. And if you look at it, the first point I made about secular bull markets is you really want to make sure you step back from time to time and get that bird's eye view, from way up in the sky looking down, and seeing the big picture, because you get so caught up in the day-to-day sometimes. You think, oh my gosh, market's down a couple of days, or this stock's going down, or, and you start building negative thoughts. And I know from trading, it's not an easy thing to overcome. But the one thing that helps me is to just take that step back and look at the big picture. This is the 100-year chart. I don't know if it can get much bigger than this. And while our markets today are a lot different than they were back in the 1930s and 40s and 1950s, 60s, even in the 1980s, a lot of things have changed, but history does tend to repeat itself. We go through cycles. And I think that's important, because these red shaded areas are your secular bear markets. These blue directional lines are your secular bull markets. And looking at what we can expect during secular bull markets versus bear markets is very different. And I think it's important that when we look at what happened in the pandemic and the initial huge drop at the beginning of 2020, look back at 1987. We had broken out 1980 above all these prior highs. So 7 years later, after we had broken and confirmed the next secular bull market, we had a crash. And look what happened after that crash. Anybody who thought, oh, well, we've come back up too much after, in 1988 or 1989, oh, we've had this huge rally, we can't go up any further. Look what they missed. I think we're looking at the same thing. I really do. Here was your breakout in 2013 above the secular bear market highs. Where were we in 2020? 7 years later, just like 1987. Had the big drop, and then we came right back, had a huge move to the upside. I don't know that we're going to get this kind of average annual return. That was huge, 15.5% per year over a 20-year period. But we're at 13 1/3 right now, and I wouldn't be surprised to see that continue. If you project 13.3% a year for the next 10, 12 years, you're going to see pretty high numbers, many thousands of points higher than where the S&P 500 is right now. If you think 3,700, you think 4,000 is a big number. Well, I think by the end of this decade, we'll be over 10,000. So, how we get there, that's what we're going to try to help everyone with. But I think eventually, if we could just fast forward, not that I want to, but if we could fast forward 10 years, I think we'd be looking at the S&P much, 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 much higher than where we are. So that's the first thing you got to take away, in my opinion, from a secular bull market, is always keep that bird's eye view in mind. The second thing, this is more from a trading perspective. When you're going through a bull market, the way the market works is Wall Street accumulates stocks before you ever see the news. You have to understand that when stocks are being bought, heading toward their earnings, it's not something random. You've got Wall Street analysts that have been visiting companies. They go out and they visit with all these different companies, their competitors, and they go out and they handpick what they believe are the best companies based on their product, their backlog, their product mix, their gross profit, their earnings, the management team. They evaluate the management. They do all this work. They've got their MBAs on staff, and they go back to their offices and they start buying. So what I do is simply consider them to be my research. They go out and they do all the work. I don't have the luxury of calling up Applied Materials, management team to find out what's going on. They'd hang up on me. They'd never answer in the first place. Wall Street does that. That's the one advantage they have. So our advantage is to watch what they're doing. And if you take a look at this, and I've talked about this a lot because I'm a student of history. I like to analyze numbers. But if you look at the time period on the calendar leading up to when earnings season starts, I want you just to focus here down on these four numbers. December 28th to January 18th, this is the period we're in right now, the annualized return of the S&P 500. Now, this is just the last decade, but I can tell you it goes back 7 decades. The last decade, because I just wanted to pull out this bull market, secular bull market, 35.16% is the annualized return. Now, if you look back up here, an annual return back in the 1980s and 90s, 15.5, that was the average annual return. We're talking about annualized returns more than double that as you're heading toward earnings season. And all of these are pretty much the same. The June to July was massive. September to October wasn't quite as strong, but they're all strong, all 4 of these. And it just tells you this is kind of your proof that Wall Street buys stocks before the earnings come out. Very important. Another thing to understand, and I could go on and rant about diversification for a long time. Listen, I get it. If you want to be diversified, I get it. Be diversified. But if you're following the market closely, I think diversification holds back your returns, especially in a secular bull market. So I went back and I did this analysis. I just showed the S&P 500 since April 10th, 2013. April 10th, 2013 was when we broke above these two highs. So from this point, oops, didn't mean to do that. So from this point forward, this period is what I'm analyzing down here. S&P 500 has been up 139%. Look at the aggressive groups. Look at what happened if you focused on technology, on consumer discretionary, communication services. These 3 crushed the S&P 500. A lot of folks think, okay, I just want to get the S&P 500 return. And that's fine if that's what you want to do and you want to spend your time elsewhere, not really concern yourself with the market, that's fine. But if you're going to be more involved and you really want to try and get your financial future set up the best you can, pay attention to these numbers. In a secular bull market, aggressive sectors outperform. Look at the defensive groups. Now, healthcare has a component of aggressiveness in the biotechs, and even maybe a little bit with medical equipment. The others are a little bit more defensive, especially pharmas. But you can see healthcare a little bit outperformance relative to the S&P. These other defensive groups underperform. So if you're buying the spider, you're buying some of this. Our portfolios, if you go back and you look at the numbers and you want to know why our numbers are so great, I can tell you why. It's really simple. We have almost none of these groups in our portfolios. And you might say, well, that's just too risky. Well, I look at the other way. I think it's too risky. If I believe we're going to go higher, why do I want to put my money into companies that underperform in rising markets? I think the risk is being too diversified. But, I don't want to change anyone's mind who's very conservative. And listen, if you're, retired and you've got, you're depending on income and so forth, ignore what I'm talking about because that's not really, it's not important if you're already to the point where you've retired. I'm talking about somebody who maybe is my age. I'm 59, maybe younger, 40s, 50s, and you're building and you're still 10, 15 years away from when you, at least, when you think you're going to stop working and you really want your money to work for you. I think you need to be thinking about these aggressive groups. Stay the course. I can't tell you how many times over the last 9 months I have seen articles or I've read, or talked to people who do this for a living who have said, we've just gone up so much, we can't go up anymore. It's unbelievable. The market has to pull back. It has to. It's going to go back to 3,000 on the S&P 500. I don't believe any of that. And, before you start thinking that, I want you to first go back and look at this big picture. Tell me how many times after that 1987 crash did you truly have an opportunity for a big pullback? Even back in the 50s and 60s. I mean, you might have to wait 3 years to get a 20% pullback. I don't know when it's going to come. 20% pullback in a secular bull market is a big pullback, and it doesn't happen often. So if you're sitting back waiting for that 20% pullback, I think you're probably going to put yourself behind the technical 8 ball. Look at the S&P 500 though, because I also get emails. You're perma bullish. You're always bullish. You're always talking bullish. Well, look at what we're seeing. I think I've been proven correct. I think I'm on the right side of the market. The S&P 500 over the last 71 years has gone up 52 of those years. So if you're always looking for the market to pull back, well, you were right 19 of the last 71 years. I'd rather be right 52. That's not even considering what we're looking at technically. That's just historical information. During secular bull markets, that goes up to 38 out of 48 years where we go higher. And if you go back and look at the years when we went lower, most of them are fractionally lower. A couple percent here, 5% there. I mean, rarely do you have a big move to the downside. 2020, we had a pandemic. We finished up 16%. 1987 crash. I believe the S&P 500 finished up 2%. We just don't stay down long in secular bull markets. Now, if you look outside within secular bear markets, that's when the tendency to see up years is not as great. But do you see anything in the charts that looks like a secular bear market? I don't see it. So anyway, just stick with the technicals. That's the bottom line. Follow the charts. Don't follow the media. And some of you, maybe you swear by the media. I don't know. I don't trust the media because I know that they don't care about my personal financial interest. They care about someone clicking on their article. That's what they care about. And so as crazy as the headlines can get, that's usually what you're going to see to try and get somebody to click on their article. And so, we had to deal with that through March and April. I think it cost a lot of people a lot of money. I think it was irresponsible journalism. And so, yeah, I'm pretty bitter about it. I think that the media drives people to do things that they want them to do, not necessarily what's good for folks. So anyway, long dissertation today, but I thought to start the year, I think it's really important to kind of put things in perspective. And that's what this first Trading Places Live of 2021 is all about. I do want to just point out before we wrap up the show, here's your year-to-date relative strength on the industry groups. So if you want to see the top 10 for 2020, it's right here. Automobiles, renewable energy, non-ferrous metals, think Freeport-McMoran, FCX, because that's basically what this index is. Computer hardware, broadline retail, toys, delivery services, software, semiconductors, internet. There's your top 10. Just about all of those areas are high growth. And that's what led in 2020. Now, if you go in and maybe look at the last month, you'll see a little different. There's autos, there's toys, there's computer hardware, but we've got some new faces in here. One that I really like, I've been talking about, is broadcasting and entertainment in the communication services. I mean, look at this move to the upside. This is a relative move. Look at that relative move in November. What was in November? Vaccines. This is a group looking ahead. I love Disney. I own Disney. I think Disney is going to have a tremendous 2021. Now, let me go on record. I said the same thing at the beginning of 2020, and Disney got hit hard with the pandemic. Of course, I didn't see the pandemic coming. Maybe we have another pandemic coming. I don't think so. I hope not. But anyway, I like Disney. I like the broadcasting and entertainment. One last thing. We're going to wrap up with the first three you must see of 2021. And I'm going to focus on something I talked to our Earnings Beats members about in our first ever short report. So the Earnings Beats, the EB short report was mailed out over the weekend. And I think this short squeeze chart list that we have is honestly a mountain of gold. Now, you have to be willing to take some risks, and you're not going to make money on all the stocks, trust me. And you don't even want to own most of the stocks in a heavily shorted chart list, companies that are the most heavily shorted companies in the market. But when these companies break out, look at Blink. When it made this breakout in November, look at the volume surge and this huge move to the upside. If you're in on this, if you catch the breakout and this stock is heavily shorted, this stock went up 4 or 5 days in a row after the breakout, where you could have more than doubled, maybe 140% on your money in a week. Now, you're not going to get it right at the top, but if you just keep your stop in below the prior day's low, you just keep riding it until the market takes you out. Sometimes these moves can be astronomical. Same thing here, another one. We broke out here above $35. It didn't stop until after we went through 55. And even if you waited until You got that lower low, you're still at 45. I mean, that's a $10 move on a $35 stock in a week. Pretty impressive. Some of these moves are pretty impressive. So anyway, that's Blink. Let me give you two more. Here are two that I think are worth watching. And maybe if you want to be aggressive, owning. We just opened 9:30, so market just opened. But here is Michael's companies. Notice we're just starting what could be a big advance to the upside. An aggressive play would be to enter. That's, again, very aggressive. You've got to keep your stops in play. You don't want to hold on to a heavily shorted stock, especially if it fails to make a breakout. So you've got to be willing, in the case of a stock like this, you might have to be willing to take a 5% loss. Yesterday or Thursday's low, I think it was 1240 something. If I were to get in today, I would have a stop below that level, 1246. So from 1309, you're talking about 63 cents. That's just under 5%. You might get stopped out today. Boom, 5% gone. Or this could be the start of what we saw with Blink, something like that, kind of like what we saw here. Boom, 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 straight up. That's what you'd be possibly looking at. And then the other one, same principle, short squeeze. This one, I think, actually, I wrote about this one. I told you at the beginning of the show, if you're not a member of our Earnings Beats Digest newsletter, our free newsletters, email and name, that's all you need. No credit card, unsubscribe at any time. Let's go back here and take a look at DDS. This was sent out to our members on November 30th, right here, talking about the triangle that it was in, and it looked very bullish, and it's heavily shorted. Look at what's going on. It finally did break out of the triangle, held the 20, and now it is really starting to make a push to the upside. So Dillard's looks very good. Let's see if it's showing down 81 cents to 63, but I'm not seeing a candle. That might be, maybe that's last week. That's probably Thursday's action. But anyway, DDS is another one that I would certainly keep an eye on. All right, that is it to open up 2021. Again, Happy New Year, everybody. To all of our Earnings Beats members, I cannot tell you how thankful and appreciative we are at Earnings Beats that you've supported us. Returning back from Stock Charts to Earnings Beats back in September of 2019 was a really tough choice. Great opportunity for us at Earnings Beats to really build on something. My daughter came to work for me. She's been out on maternity leave. I'm going to welcome her back today. She comes back into the fold. She's been out for a few months. But we're looking forward to a great 2021. And honestly, we really owe it to all of our folks that have supported us over the last 16 months or so. So again, a great big thank you, great big Happy New Year, and let's have a great 2021 together. Happy trading, everybody.